But anyways, today we're going to continue chapter 1. We started a little bit last week on the general accounting vocabulary, what is the users of financial statements. So let's just do a brief review before we continue to some of the other organizations in the accounting profession that you will need to know, the purposes of those organizations. And then later today we'll also be going over some of the business organizations that you need to know, have a general background. We'll be focusing on the corporation type of business, because again, we're learning throughout the entire semester, we're learning how to do financial statements for corporation type of business. Okay, so let's just do a brief review of what is accounting. So after this slide, there were a few bullet points of the main points of what accounting represents in the business. So tell me just some of the characteristics of exactly is an accounting system. How does accounting play a role in the business? Measures business activities, that's the first point, right?
Tracks transactions.
We could record transactions based on the business activities that happens on a daily basis. And most importantly, these are the business activities that relate to dollars, right? Monetary terms. So we're only capturing events in the accounting system that relates to dollar amounts, outflow, or inflow, right? So we talked about measuring business activities, we talked about presenting these in monetary terms. And then after summarizing information, the main goal is to get to what? Main goal. Remember the 4 things?
Income statement.
Financial statements, which the first one is income statement. Anybody remembers the main ones?
Statement
of retained earnings. So all of these we'll be going over in more details later. We also have balance sheet, which is a more comprehensive statement compared to the first 2. And we have statement of cash flows. Okay, so there are 4 statements. What we're trying to do is to capture information that happens, the business activities that happens on a daily basis within the organization, summarize this information, provide them in a set of reports so that people who work outside the business, and who contributed capital to the business, and lend money to the business, will have an understanding of how the business happens to operate, how well the financial position is. Okay, so the whole purpose of learning all of these, our goal at the end is to learn how to do a set of financial statements for a corporation, because we want to communicate business operation results to decision makers. Okay. So speaking of decision makers, remember we talked about a few parties that needs to know the information of business activities. Did you name a few?
Creditors.
We have creditors.
Investors.
These are the people who borrow money to the corporation. Investors. Investors contribute capital to the business. Business owners. The managers, they need to set goals, revise their strategies. These are the people that listen to financial information. There's also individuals, taxing authorities. The taxing authorities needs to revise corporate income tax, whether the filing is correct, how much the governmental agency is going to tax the corporation based on sales information provided. Okay, so we have owners, again, that needs to set the goals, adjust the goals based on past information. They also need to set budgets for future seasons based on past information. Investors contribute capital to the business. We'll be going over the details of what corporation is about. This links to the importance of why investors need to know the financial information. Because they're contributing capital to the business, but obviously they want to know how well the business is doing. We definitely don't want to throw their money in a corporation and never get return back from it. Okay, creditors, we have the party who loans money, it could be bank, other corporations that borrows money, signs on promissory notes to the corporation, they need to get the money back later plus interest, usually. This depends on the time frame. There's also interest involved. Creditors need to evaluate how well the business is doing and whether or not they're able to pay back. Okay. Individuals, you and me, if we're neither of the other parties, bank statement, credit card statement, broadly speaking, we use that to analyze your allowances, your expenses. You can also set some of the plans for future months, how much money you're expecting to spend. Generally speaking, you're also utilizing some accounting information that you use to your own personal activities. This is not business activities, but still accounting information that you use to your daily expenditures, your daily allowances, if you have a part-time job or full-time salary. Taxing authorities, again, need to review financial statements, make sure that the appropriate income tax they're receiving is also correct. Okay, so these are the 5 main parties that needs to use financial statements. So in terms of users, in terms of the purpose of information, we can further divide the accounting field into financial accounting and also managerial accounting. Okay? So the main differences between these two fields is whether or not these users of financial statements are working inside the business or they are people outside the business. Okay, so we're learning in this course financial accounting is the first listed here. We want to provide information for external users. Meaning these are the people that don't actually work in the business. They're not able to monitor and evaluate daily operations themselves. However, they do contribute capital to the business, so they have a right to know what's going on with the company. So investors, creditors, taxing authorities, these are the people, the party that works outside the business, but they base their important decision on the financial statements information disclosed from the corporation. Okay, so when we're learning this course, we're focusing on the upper part. Later on after you take the course, we'll be taking managerial accounting. Then the focus of the information, the audience is targeted on people who work inside the business, management level. It could be different departments management level. So these information compared to the set of financial statements, relatively speaking, is not as comprehensive, not as exhaustive, because really these managers from different departments, they may only need to know, for example, purchasing side of the information or sales side of the information. So this information we're learning in another course, they'll be more geared towards specific managers' requests of the accounting information, certain departments, certain business cycle. Okay, so as opposed to that, financial accounting is more comprehensive. The set of information that we provide is income statement, retained earnings, balance sheet, cash flows, is more comprehensive and more thorough. Because our audience are the people who do not work inside the business that needs to know the information that happens within the business within a certain period, so they're more comprehensive in a sense compared to the information here provided in managerial accounting statements where the audience is people who actually works within the firm. Okay, so the division here is based on in terms of the users of financial statements, in terms of how comprehensive the statement is. Again, investors, creditors, taxing authorities, people in the parties who need these information, they are not workers or employees in the firm. Questions so far? Okay, let's move on. Let's do a brief exercise here. Spend a minute to read a problem. See if you can try to answer these 2 questions. Problem tells you, suppose you're the manager of this company and you need bank loan. You need to request a loan from the bank in order to purchase new equipment. Say the business just started, they don't have enough money. And in terms of evaluating the loan requests, the banker requests information related to the assets, liabilities, stockholders, which really are the information that later when we talk about financial statements, you'll be learning that these are the information that will be represented in the statements. The basically the banker is requesting statements in terms of making their decision whether or not to borrow money to the corporation. The question here is, which of the 5 categories that we mentioned earlier would a banker fall into? Creditor, because these are the party that decides whether or not to loan money, borrow money to be another corporation. Very good. What about the second one?
External.
It's considered external because the simple answer would be they're not working within the corporation. They're outside parties who are trying to loan money to the corporation. They're not management level, they're not employees, they're not the owners of the business. Okay, so these are the people who work outside the firm, which is why they need to rely on financial statements to make their decisions. Okay, so the purpose again for this entire course, we're learning how to summarize information of business activities in monetary terms so that people who work outside of business have an understanding of what's going on within a certain time frame. The next 2 sections, let's just briefly go over some of the organizations in the accounting field that you should know, who sets the standards, who formulates this test for CPAs, and then I'll be going over some of the possible opportunities if you're an accounting major or if you're interested in selecting this field as a major later on, what are the occupational opportunities that you'll be getting. Then business organizations. Later on, we'll be going over different types of organizations, and then specifically then focus on corporation type of business. Here you see 4 boxes highlighted in blue. The upper 4 boxes are the organizations, associations in the accounting field. Bottom one here is not an organization, it's simply the initials for generally accepted accounting principles, which basically is what you learn in this course. Okay, so if we start from the top, FASB, this is what we call Financial Accounting Standards Board, its initials. FASB sets the standards and formulates the principles that accounting field as corporations, when they file financial statements, they need to follow these set of standards called generally accepted accounting principles. And so FASB is a privately held organization and it sets the standards for this is a U.S. rule book for accounting called Generally Accepted Accounting Principles. So what you will be learning in this entire course basically is elementary level of GAAP. Called GAAP is Generally Accepted Accounting Principles. Later on, you take intermediate courses, advanced accounting courses, you'll be learning even more comprehensive set of principles in GAAP. Okay, so throughout this entire course, from chapter 1 all the way to the last chapter, everything you learn in these chapters is part of this GAAP, Generally Accepted Accounting Principles, set by Financial Accounting Standard Boards. This Financial Accounting Standard Boards, this is a privately owned organization. It's overseen by the U.S. governmental regulatory agency called SEC. So if you have been following business news, you probably already heard about SEC, Securities Exchange Commission. It oversees the entire financial market, sets the regulations for tradings, stock exchanges. So it also oversees the formation of financial accounting standards. Okay, so the second blue box oversees the first FASB organization. FASB sets the standards, Generally Accepted Accounting Principles. So you need to know what GAAP is, basically. This entire slide, the most important key takeaway here would be the first organization that sets the standards and what is the name and the standards that U.S. accounting is following. Other associations, AICPA stands for American Institute of Certified Public Accountants. So this is Texas Association for CPAs, and they set the ethical standards that auditors need to follow. They also create the CPA exams. So if you will be taking CPA exams later on after graduating, if you're an accounting major, you'll be registering and getting information from the AICPA organization. Recently, a hot topic in the accounting field is whether or not GAAP will be converged to international financial reporting standards. So IASB is another organization that sets another set of standards called International Financial Reporting Standards. Right now, this is still an ongoing issue of convergence. So earlier there were news saying that in 2012 we're going to change to IFRS. So far, we have already stepped into 2013, so this is something that's still ongoing. FASB is working with IASB to see which are the areas that needs to be converged. GAAP needs to be converged to IFRS, but so far there's no official announcement yet. Okay. However, if we do converge a portion to IFRS, when you learn this course, I have to say, assure you, for the most part, it's not going to change too much, okay, because this is the grounding of accounting. We'll still see assets, liability, equity, and financial statements. The grounding is not going to change too much. In certain areas of later on you'll learn in intermediate accounting or advanced accounting may be changing. Okay, so you just need to know that there's a set of standards that recently in the accounting profession. There's an ongoing discussion whether these two will be merging together. It's called International Financial Reporting Standards, IFRS. So the main focus here, you need to know what is the organization that sets the standard, FASB. It's overseen by SEC, governmental regulatory agent that oversees financial market. The standards that we're following and we're learning in this course and also later accounting courses are all part of generally accepted accounting principles. If you choose accounting as a major, later on if you graduate, there's several opportunities. You can work as a public accountant or a private accountant. So public accountant is often we hear as auditors of big four firms. Deloitte, PricewaterhouseCoopers, KPMG, Ernst & Young. These are the big auditing firms that if people after graduating as an accounting major, if you work for big four firms, oftentimes you're considered public accountants. So the major part of your work is to examine financial statements that you'll be learning in this semester, examine financial statements of corporations, assuring that those statements are without significant error or fraud. Okay, so the major part of what public accounting does as auditor is to examine financial statements, assuring the public that financial statements are without material misstatement, meaning without significant error, without fraud. Now, if you choose to work for private accounting, meaning work for certain corporations, inside their corporation's accounting department, a major part of your work would be doing financial planning, financial management, financial services. So basically, you're working for the firm instead of examining statements. Okay, so we have public accountants and private accountants. Public accountants, if you pass and get the license, pass the exam, get the license, you become a CPA. Private accounting, you can also get the license, it's called CMA, Certified Management Accountant. These are just some of the information for your background in this profession. I wouldn't ask you to memorize too much of this, but just so you know what exactly is this profession about, or some of the career opportunities. Okay, so for this slide and the next slide, we go over some of the salary numbers. You don't have to memorize anything else. You just have a general understanding of what this profession is like. viewers want to guess how much an accounting can make annually? Let's say as an undergraduate student, after you get your degree, bachelor's degree, you want to work for Big Four firms. Probably guess around how much is the annual salary?
40.
You're good. Yes, 40 something. Usually, generally speaking, about 45,000 to 50,000. So I notice in the textbook you have the numbers. These are the numbers from 2007. In the textbook, this edition was out. Did a recent search last year. If you graduate as a bachelor's degree, start to work for the Big Four firms, or even private accounting, generally speaking, the annual salary would be about $50,000. It's actually, relatively speaking, it's considered pretty good, fairly well, compared to having a bachelor's degree in other professions if you start working in other departments. Okay, but if you have a master's degree, after another year or year and a half, then your salary will bump to another 10% more. Okay. Now, if later on you continue to work in the, let's say, the Big Four firms, you get your license, CPA license, slowly you get promoted, you didn't have any significant issues happening within your career, about 10 to 15 years later, you may be able to get to this level of salary as a partner. 150,000, ranging from 150 to 500. Okay, so this is at a partner level later on, meaning you will be the person responsible for assuring the financial statements. So as a bachelor, as an undergraduate student, as a master's student, when you're out of the school, start working in a firm, you're typically working in an auditing team. And later on, when you reach to the partner level, you'll be the one signing off. So, signing off and ensuring that financial statements are really audited, and they are really free from material errors and fraud. Okay, so this is a general background of if you work for a public accounting firm, it will be the starting salary. If you work for a private accounting firm, generally speaking, if you reach to the CFO level, it will be about the same as a partner here in the CPA firm. Okay, so both ways are pretty good opportunities. If you choose accounting as a major, you can see that I'm selling it here. But definitely, I have to say, in terms of coursework, there's a lot of loading, a lot of work to do. So typically, the coursework for accounting majors, compared to other disciplines or other fields in the business, the course load is heavier, slightly. Okay? But if you really get the concept and you find yourself interesting in this area of knowledge, then this definitely could give you a lot of opportunities. Not even public accounting, private accounting, you can also work for taxing authorities if you're interested in tax areas, also governmental accounting. Okay, this is a general background of the organizations in accounting, some of the job opportunities later on, some of the information that you might find interesting in Chapter 1. Other things to mention briefly is just the ethical standards for these both of these career opportunities. So for public accountants, the ICP has a standard professional conduct. It includes guides. CPAs have to do their work in terms of independence issues, due diligence, their responsibilities, how to work with clients. IMA, private accountants, they also have, this association also sets the ethical standards for these private accountants to follow and abide by. And so this is, I want to mention this because the ethical part in our profession is very important. And I would say it's also as important for other professions. But since auditors will be assuring financial statements, making sure that they don't have significant errors and fraud, private accounting, we also have controls. We may be doing internal controls, financial planning, managements for the business. We'll be accessing a lot of the information related to profits, revenues, expenses side. So for the entire profession, ethical standards are really an important and critical role. So meaning that the integrity issues is very important. Notice that there are some of the financial crises, some of the news that you see like Enron, WorldCom, all of these basically goes the opposite side toward the ethical standards. So this I have to reinforce here, and the chapter also brings us up that ethical part, ethical conducts, following these standards are really important. or not the companies have been actually doing the financial statements correctly, without material misstatements. Okay, let's move on to the next section here. I'm going to go over some of the different types of business organizations. I'm trying to introduce to you proprietorship. At a general level, we would say that business organizations can be divided into 5 types. Okay, so we have proprietorship, partnership, corporation that I highlighted in purple. This is the one that we're going to be focusing on this entire semester. Limited liability partnership and company, and not-for-profit. Okay, so just by the terms here, you can see that first proprietorship has a special characteristics that is very different from all the others, is that there's only one single owner, one single business manager in the entire firm. So proprietorship means that you don't have multiple partners, you're the only one in charge of the entire firm. Okay. Single owner that opens up a firm, could be an attorney firm, could be an accounting firm that takes care of tax services, attorney firms that takes care of lawsuits, consulting services. As long as there's only one person in charge of the firm, it's considered a proprietorship type of business. Okay, as opposed to that, partnership, basically just by its name, you know that it has multiple owners. So there are 2 or more partners, co-workers, co-owners of the firm, and both of them, they have a binding contract. They're mutually liable for each other's actions. So meaning that if I do have a partner, let's say her name is Tiffany, for example, and if Tiffany goes to loan money from the bank and did not tell me in advance or even later on if she didn't pay back the money, I have the same level of responsibility as her. So all the actions that she makes in terms of business perspectives, I have the same level of responsibility. So we have a binding contract. Whatever she does, I'm also responsible for. Vice versa, whatever I do in terms of the business activities, she is also responsible for that. Okay, so the co-owners for partnership type of business, they have a binding contract. They're mutually liable for each other's actions. These type of business, the partner, the co-owner that you choose to form a firm will be very important. You have to have a certain level of trust in that person. Now, as opposed to partnership, that kind of binding contract, LLP stands for Limited Liability Partnership. Just by its name, limited liability means that each and every partner and owners are only responsible for their own action. Introducing this at a general level, in terms of business law, there's also more detailed restrictions. Some of the LLPs, they have to have a general partner that is usually liable for everybody else's actions. But generally speaking, at a general level, this has an opposite characteristics compared to partnership. So limited liability, for the most part, the 2 or more partners, they're only responsible for their own actions. So what partner A, partner B does, it's under their names. It will not affect my personal bank account. Or I'm not responsible to. I don't have the same responsibility as for their actions. Okay, so this type of business, since it protects partners based on their own actions, it's considered more popular compared to the second partnership type of organization listed there. Not-for-profit organization, it's easier to understand. Basically, the purpose is for education, charity purposes, could be religious purposes. These organizations, they don't really call, the people who control these organizations are usually called just members or fiduciary board members. They call themselves owners or managers. So these are volunteers who set up the organization for the purpose of religious, charitable, educational goals. Okay. And usually non-for-profit, their income are not taxed by the taxing authorities either. Okay, so we have proprietorship, single owner, that takes care of all the activities in the business. We have partnership, 2 or more co-owners, and they have mutual liability contracts. They're responsible for each of their actions, and have the same responsibility level. Limited liability partnership basically is the opposite of general partnership organization. They're only responsible for their own actions and not other partners. Not-for-profit has a different purpose. It could have also multiple members in the board taking care of not-for-profit organization. I'm saving corporation to the last. Corporation is a special type of business that has multiple owners. Usually we call these owners interchangeable terms: shareholders, stockholders, investors. All of these are referring to the owners of the corporation type of business. So it can easily have, as a public traded company, it can easily have hundreds of shareholders. And each and every shareholder, as long as they purchase a share of the stock, they become a part of the owners of the corporation. Okay? So a corporation type of business, you have multiple owners, and these owners, like you and me, if we purchase stock from Amazon, let's say from Walmart, we are not responsible for the organization's liability or debt. Okay, so at most I can lose is the money that I use to purchase the shares. Let's say the business disappears later on, assuming it goes bankrupt. At most I can lose is the money that I use to purchase the stock, to purchase the share, but I am not responsible for paying back the business's debt. Okay? So if I use $1,000 to purchase the number of shares from certain public traded companies, at most I can lose that $1,000. I will not be responsible for example, $10,000 of debt and liability that they have on their statements. I'm not personally liable for those issues that goes on in the business organization. The corporation type of business is owned by multiple stockholders. As long as a person purchases a share of the stock, they become one of the owners of the corporation. The advantage here is that these type of business can easily raise capital because of the characteristics that I just mentioned. These shareholders are not responsible for the debt of the business. Okay, so these are separate entities. We as shareholders and the organization, the business itself, we don't have the same accounting records. But for proprietorship or partnership, generally speaking, they're personally liable for the debt that happens in the business. So let's take a look at this table. It's even more clear. This states all the characteristics here. We'll be focusing more on owners and liability for these owners. We can take a look at the first column here, proprietorship, and it has one single owner, and the proprietor owner is personally liable for all the actions in the business. Okay, so in a business law perspective, the person who is in charge of the business and the business itself are not separate entities. So any debts that occur in a proprietorship firm, the debt holders has the right to seek the person who's in charge of the business to pay them back. That's what it is. So the proprietor, the business owner, could be paying off of their own pocket if the company is not generating profit. They're paying off of their own pocket to pay back the debt. So they're personally liable for any debts, any situations that happen in the firm, in his own firm. Partners, 2 or more people owning the business. Partners are also personally liable for any situations that happen within the firm. And again, partners, the strong characteristic here is that they have mutual liability. So other partners' actions, again, the other partner will be at the same time responsible for it. You can see a corporation type of business here. We have many different stockholders, and lifetime is indefinite. Stockholders are not personally liable for the debt. Okay, so what happens in a corporation type of business is usually you will have a few organizers that wants to start the business, and they file the charter in the state. Once that gets approved, then the shareholders, they elect board of directors Board of Directors select the president of the firm. President of the firm then appoints the vice officers. Officers, vice officers for different departments. So then those are the management level that takes care of the business activities inside the business. But then once they raise capital from the public, you have multiple shareholders contributing capital to the corporation. These shareholders are just considered investors, owners, but they are not responsible for even on the debt that happens in the business. These are separate entities. Okay, so as opposed to these two, stockholders are not personally liable, which is why this will work in publicly traded companies. You can easily raise capital from people. As long as people do their investment and make sure that the money they use to purchase the stock is the money that they have in their pocket and they really can live for without it. At most they can lose is just the money that they purchased stock from, nothing more than that. If things are going better, if the company that you contributed capital to are prospering or growing, perhaps later on when you sell the stock back to the market, you can generate profit in return. So you might be purchasing it at $100, selling it at $200 if the company goes well. And whether or not it goes well or not depends on the information that you can get from financial statements. So this will give you some hint how well the financial position is, which is why this course is important. Okay. All right, so for this entire table, really the important part is to know the owners, how many owners are there in different types of organizations, in terms of liability, whether the partners are personally liable or not. So I will be focusing more on the first two organizations. Okay, so since this is not really a business law course, I'm just focusing on the points, the main points of this general business background. I want to get to this in this chapter. These are the more important things for the chapters. Any questions so far? Yeah, let's take a closer look at corporations' characteristics in detail for both points. So, and these are separate legal entities, as I mentioned earlier. So it's one under the state law. The organizers file a charter. Once it gets approved, and once the company starts to issue the first share for the corporation, then the corporation officially exists in the business. So it's distinct from the owners. Again, the owners here, I'm referring to shareholders, stockholders, investors. These are the same parties. They're distinct from the owners, and most the owner can lose is just the money that they contributed to the business. And continuous life, transferability of ownership is fairly easy, meaning that you can purchase a stock today, and then I can decide to just sell it tomorrow. So then the ownership from me transfers to another person who purchases it. So ownership are transferred very easily, and it has continuous life, meaning from the shares that I purchased earlier, once I sell it, then the owner transfers to another person. This basically states this point that this is a special characteristic that other organizations do not have. Okay, because this corporation type of business is the only organization that will be able to publicly disclose financial information and also publicly trade their stocks. No mutual agencies, generally speaking, the vast number of shareholders do not act on behalf of the corporation. So the exception here will be if an officer at the same time also is a shareholder, then that's a different story. If that person is also managing the business, then of course they have certain rights and authority to act on behalf of the corporation. Otherwise, the vast number of shareholders, you and me, if we purchase stock from Amazon, we do not take care of the business activities that happens within the firm. That's what this means. Okay, so we are separate entities, and also there's no mutual agency. We don't take care of corporations' tasks. Okay, so far we talked about separate entity. We're able to transfer our ownership by selling the stock back to the market. We're purchasing other company's stock. No no mutual agency, we don't act on behalf of the corporation. There's a few other ones. So limited liability of stockholders goes back to what I mentioned earlier, and most we can use is the money that you invested in the company. You will not be responsible for any debt that happens in the business or the debt that you see in the financial statements. Okay, so there's only limited liability for you and me if we do purchase stock from certain company. Separation of ownership and management really goes back to the prior point, no mutual agency. Also, these two complements. Stockholders do not manage day-to-day operations. The vast majority of stockholders, unless they're officers, otherwise they do not manage day-to-day operations, they don't act on behalf of the corporation. So those two points goes together. In terms of government regulation, just like how we're learning this course, companies need to file and disclose financial statements, this is a regulation that is only for corporation type of business. So for proprietorship, partnership, they don't necessarily need to disclose information to the public because they don't issue stock to the public. So there will be no investors to look at those financial statements. Okay, so this is a regulation that is only for corporation type of business to disclose financial statements on a quarterly and yearly basis. So this is an example of having additional government regulation. Corporation type of business, the documents, the filing, taxes information are a lot more complicated than proprietorship, partnership, other types of organizations. Okay, so speaking of regulations and taxes, the last part would be on taxation. You just need to know here that income taxes, corporation type of business, it's double taxed. So meaning that, remember earlier we talked about taxing authorities needs these information. So corporate income tax, this needs to be filed to IRS. At the same time, if the corporation rewards investors, give them dividends. So dividends, we'll be talking about this a little bit later. Basically, this is a reward to shareholders. You and me, if we are shareholders of a certain corporation, this at the same time, when I file my personal taxes, will be taxed as well. So this is what the double tax means. Corporate income tax will be taxed altogether, and then also the dividends they issue to shareholders, they reward shareholders for. In the shareholders' perspective, when they file their personal taxes, it also has to be taxed as additional income. And so other than that, there's also state franchise tax to make sure that a company is viable in the field. This is something that's also different from other organizations. Questions for me? All pretty quiet this morning.
Could you repeat again the mutual between
Agency?
separate of ownership and management and continued? What is it?
Well, continuous life basically just means that when you purchase a stock and then you sell the stock back to the market, once the stock, that number of shares is purchased against another entity or another person, this shareholder, the ownership transfers to that person, and basically continuously having owners is continuing the life of the organization, I should say. So this is a characteristic that you don't see in other organizations because they don't issue stock, right? And the purpose of issuing stock is to raise capital for the organization. At the same time, you can decide today to purchase a stock, and if you regret it, you want to change your decision, tomorrow you sell it back to the market, the ownership transfers to somebody else. So that's basically what it means, special characteristics compared to other organizations. So all the bullet points we're listing here is we're trying to make a distinction between this type of entity with proprietorship, with partnership. You know, for no mutual agency, stockholders, you and me, who purchase stock, we don't act on behalf of a corporation. You know, we don't make decisions for Amazon, we don't make decisions for Walmart, right? Because we know for a fact that there's a board of directors, they appoint officers to take care of corporation issues. We are just contributing capital. That's what it means.
Okay.
There's no mutual agency, and this point goes also hand in hand with separation of ownership of management. It's basically the same point. So ownership are the people. As long as I own one share of a certain corporation, I'm one of the owners. But again, if I'm not the officers, I don't take care of the issues inside the business. Okay, so separation, distinction between owner and management. The last one we asked was separate legal entity, right? So separate legal entity, as opposed to proprietorship and partnership, corporation, again, you have different, think of it as this. You have your own personal expenses based on your allowances, your part-time job. The business has their own records. So it's a separate entity. You do financial statements. This is only related to business activities. Even though I am a shareholder of this business, my personal expenses, the money that I use for grocery, purchase clothes, even though I'm an owner, it doesn't go into their accounting records. It's separated. Okay? Separate entity means that organization itself is an independent entity. You have your own accounting records, financial statements only relates to business activities within the firm. Me as an owner for that corporation, all my personal expenses and activities, even though I'm an owner, doesn't go into that account. So it's separated. Other questions? Okay, if you still have other questions on these, after class, you can continue and discuss more. If not, we'll be going into a small exercise. So here we have the question, which type of business organization would meet Chloe's needs best, based on the description here. Just got a few seconds to read it. So you can match with one of the 5 organizations that we talked about.
Corporation.
How do you know that?
Well, corporations focus whether to raise capital and selling stock.
And all the other organizations do not have this feature, right? So that's basically the key of this problem. If you think about a limited life, other organizations may also have it, for example, non-profit, limited liability partnership. Limited liability also is a feature that a limited liability partnership has. But if you think of the aspect of raising capital easily, and if it's also from the public, this would be the only characteristic, that only corporations have in business tax. Okay, so if you join these 3 aspects together, then the answer would be corporations have a business. You can also refer to the table that we just talked about. Remember, 5 different organizations and characteristics. Some of them, they all have a limited life, limited liability, in terms of raising capital very easily. That's the whole point of having public sector companies. You can raise capital from general public, even though these people are not working in the business. They're just contributing capital to the business. But then later on, they look at financial statements, they can decide whether or not to buy back the stock, sell it back to the, they can decide whether or not to sell the stock back to the market or even purchase more. So raising capital very easily, corporation type of business is the one that is able to expand their capital very quickly, easily in the market. So far, we talked about the general vocabulary. What does it mean by learning accounting? What are we trying to do in this course? We're trying to summarize business activities. We talked about some of the organizations that governs the accounting profession. Remember, there is generally accepted accounting principles that is set by who? Generally accepted accounting principles is formulated, set by an organization called FASB, Financial Accounting Standard Boards. And FASB is overseen by SEC. So There's also an organization for CPAs, American Institute of CPAs. There's also IASB. There's a hot issue related to whether or not US GAAP is converging to international standards. And we talked about business organizations, proprietorship, partnership, corporation type of business, non-for-profit, and also limited liability partnership. Make sure when you go back after today's lecture to take a look at that table again. In terms of owners, do you know how many owners are there in different types of organizations? In terms of liability, remember, key aspect for corporations that we're not liable for corporations. Shareholders are not liable for corporations' debt. They're a separate entity. There's no mutual agency, right? Because we're not, unless you're the officer of the business, otherwise you don't act on behalf, we don't work with corporations, work on corporations' activities. In the second half of the lecture, we'll go into it after this. So what type of business organization is owned by shareholders? Should be easy.
Corporation.
Corporation is owned by shareholders. This will be the only organization that we mentioned that could be lazy capital from the public easily. As long as a person purchases at least a share of the stock, you become a shareholder, stockholder, investor, owner of the business. Alright, the last part of this chapter really goes into the foundation of what we're trying to learn in this entire course, the accounting equation. These are accounting concepts and principles. Again, it's set by FASB. It's called Generally Accepted Accounting Principles, what we're trying to learn throughout this entire course. We're trying to provide useful information for outside users. This is the key point here. We need to make sure that these information are relevant, reliable, and comparable. And later on, I'll be going over, the next two slides will be going over some of the general principles of accounting. We'll learn what these three terms mean. In a general sense, what relevant means is that these activities that we capture again has to relate to business activities in monetary terms. Otherwise, we will not be capturing or journalizing them. Reliable, these activities, we have to have some sort of source documents, like receipts, like contracts, anything that proves that this activity actually happens. So it has to be reliable in the sense that there's source document to back it up. Comparable, financial statements, in terms of GAAP, since we're learning the standards here, these financial statements are structured in a specific format that we'll be learning later, and also the way that we do it will make it comparable across time frame and also across the industry. The format, the accounts that we use, the rules that we use, debits and credits, this will make this information comparable. Let's move on to some of the principles I'll be going over in this course. So again, before we go into accounting equations, these are just some of the, think of these as the games for accounting, the rules for the games of accounting. We have some of the concepts that we need to follow and what does it mean when we look at financial statements. It's basically grounded in these 5 concepts here. We have, again, the entity concept, which is very similar to what we mentioned earlier for corporation type of business. Again, the business itself is separated from the owners. So this goes back to the point that I discussed with you all earlier, that business entities' records are different from my personal records. Even though I'm an investor shareholder of the business, my personal expenses, the money that I get from a certain firm, if I work for a firm, is separated from corporations' activities, corporations' accounting records that will be represented in financial statements. Okay, so I'm a shareholder, the expenses that I make, groceries, expenses, any shopping related expenses do not go into financial statements. You know, part of the job that I did was just contributing capital to the business, becoming a shareholder, but the accounting records are separated. So entity concept, meaning when you look at financial statements, all the numbers that you see only relates to business activities within the firm, nothing more than that. Faithful representation principle, making sure that accounting information that you see on financial statements are complete, neutral, and free from material error. Okay, so meaning that all of the journal entries, later on we learn about entries, numbers, debits, credits, all the activities happening in the business has to be backed by some sort of source document. Reliability often goes together with this faithful representation principle. So when you look at financial statements as investors or as creditors, you have a certain competent level that these information represented here, these activities really did happen because it has to be backed by some source document, receipts, contracts. Otherwise, it will not be recorded here. Okay, so this information, this faithful representation principle basically makes this information the outside users to have a certain level of confidence when they view this information, knowing that it's not made up. Supposedly they follow these accounting standards. Cost principle, this is very important to know, very important to keep in mind. From now and then on, a lot of the transactions, all of the transactions in accounting will follow the cost principle. Okay, so meaning that today, if our purchase supplies at $100, so today the price is $100. Next week, if I found out that the price is $200 for that same product, the same supply, I don't go back to change what I reported yesterday or last week. So whatever is the price that you purchased for certain products last week when it happened, you reported that day, and that will be the cost of the supplies that you capturing in accounting systems. If next week or next month, the same supplies, same exact product, the price is raised to a certain level, I don't go back to change the record because last week I actually just paid out $100 for that supply. So meaning that whatever happens on a daily basis, whatever is the price that you use up to purchase something, whatever is the price that you receive from customer, that will be captured on the very same day based on the money that you spent. Later on, you don't go back to change it. Okay, regardless of later on the market price raised to 3 times more than what was there last month or last week, you don't go back to change the information because that's the exact amount that we actually paid. So for each and every transaction, we have a source document, and based on the source document, whatever is the amount that you used up, the amount that you received, that will be the cost that you will be recording in the accounting system. So later on, the same exact service, same exact product, you have different prices 2 months later, you don't go back to change that entry because that already happened in the past. That's the amount of money that you received and paid out. Okay, so this is what the cost principle means. Assets are recorded at the purchase price and also at the very same day. Okay, other principles, we also have 2 more. Going concern and stable monetary unit concept. Going concern basically means that we're completing some journalizing entries, closing entity accounts, creating financial statements. We're basically assuming that this company will be viable for a certain number of years. So that means continuing the business. Going concern, we assume that business will remain in operation for the foreseeable future. The whole point of completing all this information is for, again, outside users to base their decisions on. And we're assuming that this company will continue to exist in the business world for a certain number of years. Stable monetary unit concept, we're basically excluding the fact that there's inflation. When you look at financial statements, we're using US dollar to represent all these entries. US dollar is considered a stable unit of measurement, so all these transactions we're not really considering with any types of inflation. again, when we record these entries, we're just recording it on the very same day it happens at the cost exactly represented in the source documents, on the receipts, on the contracts. Again, we don't go back to change anything. I know this is a lot of theoretical background here. So usually the first chapter takes a longer time to get everybody used to the concept. Once you have the general idea here and move on to numbers, it'll be easier to map because you'll know what I'm talking about. Okay, so this is a grounding, basically the rules, latest accounting game. We assume that, again, business and owners are separate entities. Equal representation principle, everything you see on the statements, you can have a certain level of confidence that these are the information that actually, the activities that actually happen, because usually you will have a document to back it up. Cost principle, anything, in an accounting perspective, we're recording something historically. So we're recording it at the day it happened, at the cost it happened, at the cost that it's reported on the very same day. So again, a few weeks later, the same product, the price is different. We don't go back to change past transactions. Once it's happened, it's recorded that day, and that's it. Going concern, we assume companies is viable for a certain number of years. That's the whole point of completing all these statements, providing this information for users, and we're excluding the flat inflation here, which is assuming US dollars has the same power across the years. Any questions? No, I have a question for you. Generally accepted accounting principles, as I mentioned earlier, still remember who formulates it? A Financial Accounting Standard Board. It's very good, and it's overseen again by SEC. So just remember that when you learn this course, you want to point out that it's part of GAAP. So later on, when people ask you, you're learning this course, it's part of the standard accounting principle. Yes, it is. It's part of generally accepted accounting principles. So is the content you'll be learning is intermediate accounting, advanced accounting. They are all a portion of generally accepted accounting principles. Okay, now let's take a look at what an accounting equation is. This will be the rounding of all financial statements, especially balance sheets. Balance sheet would see the left-hand side assets would equal the right-hand side liability plus equity. So at a high level of interpretation, let's just think of this as a bunch of things that a company owns. A bunch of things that a company owns. The value of these assets would equal a bunch of things that you owe to a third party plus the remaining value of the business.
Okay, now it's on.
And so the definition of assets really is the business resources, economic resources in the business, what the business owns, what they use money to purchase.
It's on.
And also these are the things that help help the business to generate profit, generate sales revenue, service revenue, these are the economic resources. Liability and equity, they're both claims to economic resources. So they're requesting some sort of resources from the asset section. That's what it means. And now if we rearrange this equation a little bit, this also equals, this is the same as saying assets minus liability equal equity. So meaning what you own in the business, altogether the value of what you own, minus what you owe to the bank, owe to creditors, what you owe, will give you equity, which is the net worth of the business.
It's coming down.
Okay, so assets is what you own, liability is what you owe. You have these two numbers and you subtract what you owe from what you own. What's left basically is the real value of the business, we call it net worth of the business. what you owe from what you own gives you the remaining value, the net worth of the business. So you have it. Okay, so if you put it back to the original equation, when you own equals claims to resources, when you owe to a third party, plus net worth of the business. You can think of this as claims from shareholders. Because equity release net worth of the business also leads to the capital that shareholders contributes to the business. Later on, they will be claiming, for example, dividends, being able to reward them with dividends.
I think so.
This is a general idea. Economic resources on the left-hand side will equal claims to economic resources. Claims from investors, claims from creditors.
That's a red one. I guess. Red one.
Okay, let's fit this in with numbers.
Yeah,
So let's say altogether the value of assets were $5,000, and what you owe to bank or third parties altogether worth $2,000. So if you subtract the $2,000 from altogether the value of assets that you own, the net value, net worth of the business really is only $3,000. Okay, so that's what this entire equation means. Left-hand side, what we own in the business altogether seems to be $5,000, but don't forget that if you borrow money from creditors, there's a part of these $5,000 later on will disappear, because you will have to pay the money back, pay the interest back. So after subtracting the part that you owe, whatever is left will become really the value of $5,000. And so again, assets, economic resources would equal claims to economic resources by creditors, and also equity, think of this as claims from shareholders. Take a closer look at assets definition. Again, assets are the resources that benefits the business in the future. Some of the examples here. Cash, hopefully, is the most important asset a business has. Because all the other business activities pretty much all leads to cash. And if it's not cash immediately, it will be cash later on, accounts receivables. So cash is the thing that you use. We all know what cash is. We use this to purchase materials, to purchase furniture, purchase land, purchase inventory. You may be trading an asset cash for another type of asset. So if you purchase a piece of land, purchase furniture, purchase equipment using cash, and you're exchanging cash asset for another type of equipment asset or machine asset. And that is an example of a business activity that involves two types of assets. Maybe also just receiving cash from a customer, from a client, or if you are a company that sells products, retail company, merchandise company, the customer purchases products from your business, from your store, you'll be receiving cash. So this at the same time will increase asset account. Okay, so cash is an example of asset. Each and every large categories, we have a lot of different accounts under them. Okay, so right now the slide we're showing here is the left-hand side of the equation, asset category, and there can be multiple accounts under financial statements that are all considered asset. So these bullet points are a few examples here. Later on, when we go through this semester, we'll be adding into these asset accounts. There are a few others that we haven't mentioned here. The general idea here is these are the things that supports the business to generate money, more money. These are the things that you use the money to purchase from. Machinery, maybe helping the business to manufacture new products. Furniture, land, you need your merchandising business, you need a place to build a store to actually sell products to customers, to generate sales revenue. So these are the resources that the business owns that helps them to generate more profit. It's a general idea. I'm going to stop right here.